You know, I've been investing for over 70 years now, and in that time, I've seen just about every mistake an investor can make. I've watched brilliant people lose fortunes. I've seen average folks destroy their retirement savings. I've observed markets boom and crash and boom again. And through it all, I've noticed something remarkable. The same 5 mistakes keep appearing over and over again, generation after generation, as if each new crop of investors thinks they'll be the exception to the rules that have governed markets for 100 years. I'm 95 years old now, and if there's one thing I've learned, it's that knowing what not to do is often more valuable than knowing what to do. Ben Graham used to tell me that the investor's chief problem, and even his worst enemy, is likely to be himself. He was right. The mistakes I'm going to share with you today aren't caused by lack of information or bad luck or unfavorable markets. They're caused by human nature, by emotions and psychology, and the eternal struggle between our rational mind and our impulsive instincts. The good news is that these mistakes are completely avoidable. You don't need to be a genius to avoid them. You don't need special training or insider knowledge. You just need to understand what they are, recognize them when they appear, and have the discipline to do something different than what your emotions are telling you to do. That sounds simple, but as Charlie Munger used to say, simple doesn't mean easy. Let me take you back to March of 2009. The financial crisis was in full swing. The S&P 500 had fallen 57% from its peak. Every day brought new horror stories. Banks were failing. Companies were going bankrupt. Retirement accounts had been cut in half. And everywhere you looked, people were selling, getting out of the market, moving to cash, protecting what little they had left. I remember sitting in my office in Omaha, reading the headlines, listening to the panic in people's voices when they called. And I was buying, not because I'm brave or contrarian by nature, but because I understood something that most investors don't. The best time to invest is when everyone else is terrified. The worst time to invest is when everyone else is euphoric, and in March 2009, terror was universal. That experience brings me to the first and most destructive mistake that investors make. They buy high and sell low. This sounds absurd when you say it out loud. Nobody sets out to do this. Nobody wakes up and says, I think I'll buy stocks when they're expensive and sell them when they're cheap. Yet this is exactly what the majority of investors do year after year with predictable results. Here's how it happens. Markets go up. Stocks are rising. Your neighbor is making money. Your colleague is bragging about their returns. The financial media is breathless with excitement. Technology is changing everything. This time is different. Everyone is getting rich except you. The fear of missing out becomes overwhelming. So you buy in, right near the top, when valuations are stretched and future returns are likely to be poor. Then the market turns. Stocks start falling. Your portfolio is down 10%, then 20%, then 30%. The same media that was celebrating the boom is now predicting doom. Experts are saying it could go lower. Your neighbor has moved to cash. Your colleague is panicking. You can't sleep at night watching your account balance shrink, so you sell, locking in your losses right near the bottom, when valuations are attractive and future returns are likely to be excellent. This pattern has repeated itself in every market cycle I've witnessed. The dot-com bubble in 2000, the financial crisis in 2008, the COVID crash in 2020. The mechanics are always the same. Rising markets create optimism, which creates buying, which pushes markets higher, which creates more optimism, until prices become disconnected from reality and the cycle reverses. Falling markets create pessimism, which creates selling, which pushes markets lower, which creates more pessimism, until prices fall below intrinsic value and the cycle reverses again. The Dalbar studies have quantified this behavior over decades. They found that the average equity investor underperforms the S&P 500 by about 4 to 5 percentage points annually over long periods. Not because they picked bad stocks, not because they paid high fees, but because they bought and sold at the wrong times. They chased performance. They panicked during downturns. They did exactly what their emotions told them to do, which was exactly the wrong thing. Let me give you a concrete example from my own experience. In the late 1990s, Berkshire Hathaway was underperforming the market significantly. The dot-com bubble was inflating. Internet stocks with no earnings were doubling and tripling. Meanwhile, our portfolio of boring, profitable businesses was going nowhere. I got letters from shareholders telling me I'd lost my touch. Magazine articles questioned whether I was too old to understand the new economy. Some investors sold their Berkshire shares to buy tech stocks. I didn't change what I was doing. I didn't buy companies I didn't understand just because their stock prices were rising. I stuck to my principles. I bought good businesses at reasonable prices and held them. When the bubble burst in 2000 and 2001, those internet stocks fell 80, 90, even 100%. Berkshire's stock roughly doubled over the next few years. The investors who sold near the bottom to chase the bubble destroyed their returns. The investors who stayed patient and rational were rewarded. Here's what you need to understand. Markets are driven by fear and greed in the short term, but by fundamentals in the long term. When you buy stocks, you're buying ownership in businesses. Those businesses have assets and earnings and growth prospects. Over time, stock prices will reflect those fundamental realities. But in the short term, prices can deviate wildly based on psychology and emotion. The solution to this mistake is deceptively simple. Do the opposite of what your emotions tell you to do. When markets are soaring and everyone is optimistic, be cautious. When markets are crashing and everyone is pessimistic, be greedy. As I've said many times, be fearful when others are greedy and greedy when others are fearful. This is easy to say and extraordinarily difficult to execute because it requires you to act against every instinct you have. The second biggest mistake investors make is one I see constantly, and it destroys returns just as surely as the first. They trade too much. They think activity equals productivity. They believe that making frequent decisions and constantly adjusting their portfolio will lead to better results. The evidence shows exactly the opposite. When I started my investment partnership in 1956, I told my partners that I expected our portfolio turnover to be low. Very low. I wasn't interested in buying a stock on Monday and selling it on Friday. I was interested in buying good businesses and holding them for years, preferably decades. Some of my partners were skeptical. They thought that kind of inactivity meant I wasn't working hard enough. They wanted to see action. But here's what I understood even then. Every time you trade, you incur costs. Brokerage commissions, which were much higher in those days than they are now. Bid-ask spreads, market impact costs, and most importantly, taxes. If you sell a stock you've held less than a year, you pay short-term capital gains tax at ordinary income rates. That's up to 37% at the federal level plus state taxes. Even if you hold longer than a year, you're paying 15 or 20% on long-term gains. Those costs compound against you over time. Let me show you the mathematics. Say you have $100,000 and you generate a 20% return annually. If you buy and hold for 30 years, paying long-term capital gains, only at the end you end up with about $19 million after taxes. If you generate that same 20% return but trade frequently and pay short-term capital gains every year, you end up with about $8 million. The difference, $11 million, is what you gave to your broker and the IRS instead of keeping for yourself. But the costs of overtrading go beyond the direct financial expenses. There's also the opportunity cost of being wrong more often. The more decisions you make, the more chances you have to make mistakes. The more you trade, the more you're relying on short-term predictions about stock movements rather than long-term analysis of business quality. And short-term predictions are notoriously unreliable. I've watched countless investors trade themselves into oblivion. They read analyst reports. They watch financial television. They react to every earnings announcement and economic data release. They're constantly buying and selling, convinced that their activity is adding value. In reality, they're just churning their accounts and generating fees for brokers while destroying their own returns. The greatest investor I know personally, aside from Charlie, is a man who barely looks at his portfolio. He bought shares of Berkshire decades ago and essentially forgot about them. He didn't panic in 2008. He didn't get excited in bull markets. He just held. His returns have been extraordinary, not because he's brilliant, but because he had the wisdom to do nothing. There's a wonderful study from Fidelity that analyzed which accounts had the best performance over a long period. Want to know who had the best returns? Dead people. Their accounts couldn't trade because they were deceased, so the stocks just sat there compounding. The second best performers were people who had forgotten they had an account. Again, no trading, just holding. The lesson is clear. Activity is the enemy of returns. Charlie had a saying that captures this perfectly. The big money is not in the buying and selling, but in the waiting. Most investors have the exact opposite approach. They think the big money is in finding the next hot stock or timing the next move. They're wrong. The big money is in finding good businesses, buying them at reasonable prices, and then sitting on your hands for years while compound interest works its magic. The third major mistake I see investors make is one that seems to get worse every generation. They confuse speculation with investment. They don't understand the fundamental difference between buying something because they think the price will go up versus buying something because it produces value. This distinction is crucial, and most people get it completely backwards. Let me explain what I mean. When you buy a farm, you evaluate it based on what it will produce. How many bushels of corn or soybeans will it yield each year? What will those crops sell for? What are the costs of farming it? You're buying the farm for its productive capacity, for the stream of income it will generate over the years you own it. The fact that farmland prices might go up is secondary. You're primarily interested in the crops. When you buy a rental property, you look at the same factors. What rent can I charge? What are the expenses? What's my net cash flow? You're buying an asset that produces income. Whether the property appreciates in value is a bonus, but it's not the primary reason you're buying. When you buy a bond, you're buying a stream of interest payments. You know exactly what you'll receive and when you'll receive it. You're not hoping to sell the bond to someone else at a higher price. You're buying it for the income it produces. But when most people buy stocks, they do something entirely different. They don't think about the underlying business or what it earns or what cash it generates. They think about what they can sell the stock for next week or next month or next year. They're not investing, they're speculating, they're hoping to find a greater fool who will pay more than they paid. This is most obvious with things like Bitcoin and cryptocurrencies. When people buy Bitcoin, what are they buying? It's not a business. It produces no goods or services. It generates no cash flow. It pays no dividends. The only way you make money on Bitcoin is if someone else will pay more for it than you did. That's not investing, that's speculation, or as I've called it, rat poison squared. But the same mistake happens with stocks, just in a more subtle form. People buy Tesla not because they've carefully analyzed the automotive industry and concluded that Tesla will generate sufficient cash flows to justify its valuation. They buy it because the stock has been going up and they think it will continue going up. They buy Nvidia not because they've modeled out the semiconductor industry and projected earnings. They buy it because artificial intelligence is hot and everyone is talking about it. The problem with speculation is that it's a zero-sum game before costs and a negative-sum game after costs. For every person who sells Tesla at a higher price than they paid, there's someone who bought it at that higher price. Eventually, when the music stops, somebody is left holding an overpriced asset. And with all the trading costs and taxes involved, the average speculator must lose money over time. Investment is different. When you invest in a productive asset, everyone can win. If you buy stock in a wonderful business like Coca-Cola and the company continues growing its earnings and paying dividends for decades, and someone else buys stock in Coca-Cola and holds it for decades, you both can do very well. You're not trying to outsmart each other. You're both profiting from the growth of an underlying business that's creating real value in the world. I learned this distinction from Ben Graham in the 1950s, and it's the single most important concept in investing. Graham said that investment is an operation which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. That definition has served me well for 70 years. When I look at an investment opportunity, I ask myself a simple question. If the stock market closed tomorrow and didn't reopen for 5 years, would I be happy owning this? If the answer is yes, because the business will generate good returns regardless of what happens to the stock price, then it might be a good investment. If the answer is no, because I'm counting on being able to sell it to someone else at a higher price, then it's speculation and I should avoid it. The fourth mistake I see all the time is diversification gone wrong. Now, this might surprise you because the conventional wisdom says diversification is essential. Own lots of stocks. Spread your risk. Don't put all your eggs in one basket. And there's truth to that advice for most people. But like most simple advice, it can be taken too far in both directions. The mistake isn't diversification itself. The mistake is what I call diversification. That's when people own so many stocks that they can't possibly understand what they own. They have 40 or 50 or 100 different companies in their portfolio. They bought them based on tips or articles or because they seem cheap. They have no deep understanding of any of these businesses. They couldn't tell you what their competitive advantages are or what risks they face. They're not diversified, they're just scattered. Here's the problem with owning too many stocks. If you own 100 stocks, your best ideas get diluted by your worst ideas. Say you spend weeks analyzing a company and you conclude it's an outstanding business trading at an attractive price. That's your best idea. But it's only 1% of your portfolio. Even if you're right and it doubles, it only adds 1% to your total return. Meanwhile, you've got 99 other positions, many of which you understand much less well, and they're dragging down your returns. Charlie and I have always believed that wide diversification is only required when investors don't understand what they're doing. If you know what you're doing, you need very few stocks. At various times in Berkshire's history, we've had more than half our portfolio in just 3 or 4 stocks, not because we were reckless, but because we'd found wonderful businesses at attractive prices and we wanted to make meaningful investments in them. Think about it this way. If you had the opportunity to invest with the best business manager you know in the best business you understand at an attractive price, would you only put 1% of your money into it so you could put the other 99% into investments you understand less well? That would be crazy. You'd want to put a meaningful amount into your best opportunity. Now, I'm not suggesting that everyone should have a concentrated portfolio. If you don't have the time or inclination to study businesses carefully, you should own a low-cost index fund that gives you broad diversification. That's the right strategy for most people. But if you're going to pick individual stocks, you should have strong convictions about the ones you choose and size them accordingly. The other extreme is also a mistake. Putting everything into one stock, no matter how good you think it is. That's not investing, that's gambling. Things can go wrong even with the best businesses. Management can make mistakes. Industries can change. Unforeseen events can occur. You need enough diversification to protect against the unknown unknowns, but not so much that you dilute your best ideas beyond recognition. My general view is that if you're picking individual stocks, you should own somewhere between 5 and 20 companies that you understand extremely well. Not 50, not 100. A focused portfolio of businesses you've studied carefully and believe will generate good returns over many years. Each position should be meaningful enough that if you're right, it moves the needle on your overall returns. The fifth and final mistake I want to discuss is perhaps the most insidious because it happens slowly and quietly. Investors pay too much attention to short-term results and too little attention to long-term fundamentals. They obsess over quarterly earnings. They panic over monthly portfolio statements. They make decisions based on what happened last week instead of what will happen over the next decade. I see this mistake everywhere. Someone buys a stock and then checks the price every day. If it goes up, they feel smart. If it goes down, they feel anxious. They read every news article about the company. They watch every analyst appearance. They're constantly monitoring and evaluating and second-guessing their decision based on information that has almost no bearing on long-term value. This short-term focus leads to all sorts of problems. It makes people impatient. They expect results immediately. If a stock doesn't go up within a few months, they conclude they made a mistake and sell it, often right before it starts to perform. It makes people reactive. They respond to every bit of news or market movement instead of staying focused on the underlying business quality. When I buy a stock, I'm buying a business. I'm making a decision that I expect to play out over years or decades, not days or months. I don't care if the stock goes down 20% next month. In fact, if it does and the business fundamentals remain strong, I'd be happy to buy more at a lower price. I don't care if the company misses quarterly earnings estimates by a few pennies. I care about whether the business is building long-term competitive advantages and growing its intrinsic value. Let me give you a specific example. We bought our first shares of Coca-Cola in 1988. In 1989, the stock went down. We bought more. Some quarters the company beat earnings estimates. Some quarters they missed. I paid no attention to any of that. What I focused on was the fundamental strength of the business. Coca-Cola had built a brand that was recognized around the world. They had distribution networks that would take competitors decades to replicate. They were expanding into new markets. They were growing their per capita consumption. Over the next decade, those shares went up more than tenfold. But here's the important part. That gain didn't happen smoothly. There were periods where the stock went down. There were quarters with disappointing earnings. There were times when analysts questioned the company's strategy. If I'd been focused on short-term results, I might have sold. Instead, I focused on long-term fundamentals, and that focus was rewarded handsomely. The antidote to short-term thinking is to extend your time horizon. When you evaluate an investment, ask yourself what this business will look like in 5 years or 10 years. Will it be stronger or weaker? Will it have more pricing power or less? Will its competitive position be better or worse? These are the questions that matter, not what earnings will be next quarter or where the stock price will be next month. I tell people to imagine that they're buying a private business that they can't sell for 10 years. Would they still make the same investment? If the answer is no, if they're only interested because they think they can flip it for a quick profit, then they shouldn't buy it at all. But if the answer is yes, if they'd be happy owning that business for a decade because of its fundamental qualities, then short-term price movements become irrelevant and even opportunities to buy more. Now let me tie all 5 of these mistakes together because they're interconnected. They all stem from the same root cause, which is letting emotion and short-term thinking override logic and long-term perspective. When you buy high and sell low, you're letting fear and greed control your decisions. When you trade too much, you're confusing activity with progress. When you speculate instead of invest, you're chasing prices instead of value. When you over-diversify, you're admitting you don't really know what you're doing. When you focus on short-term results, you're missing the forest for the trees. The solution to all 5 mistakes is the same. Develop a sound investment philosophy based on fundamental principles and stick to it regardless of what markets do or what other people say. That philosophy should include buying businesses you understand only when they're priced at a significant discount to intrinsic value and holding them for very long periods while they compound. It should include making relatively few decisions with high conviction rather than many decisions with low conviction. It should include focusing on long-term business quality rather than short-term price movements. I followed this philosophy for 70 years and it's worked extraordinarily well. Not because I'm smarter than other investors, I'm not, but because I've been disciplined about avoiding these 5 common mistakes. I don't chase hot stocks. I don't trade constantly. I don't speculate on things I don't understand. I don't over-diversify into mediocre ideas, and I don't obsess over short-term results. This approach requires patience. It requires the ability to sit still when others are active. It requires confidence to hold positions when they're temporarily unpopular. It requires humility to admit what you don't know and stay within your circle of competence. These aren't easy things, but they're simple things. And the investors who master them will avoid the 5 biggest mistakes and position themselves for long-term success. I'm 95 years old now. I've made plenty of mistakes in my career, but I've tried very hard not to make these 5 mistakes repeatedly. And that discipline, more than any brilliant insights or lucky breaks, is what's made the difference. I hope sharing these lessons helps you avoid the same pitfalls that have trapped so many investors before you. Now, if you'll excuse me, I've got some businesses to study and a cherry Coke getting warm. Thank you, and God bless.